Welcome, everybody. I am Daniel. I'm the founder of Startup CPG. If you're watching us on YouTube, hit the subscribe button. You'll get access to all of these great webinars. This one today, I'm especially excited about. I really appreciate all of the panelists who are here because this is one of those where I'm just like, this is a topic that needs to get addressed more right now. And then I reach out to three of the best people out there that I think can really, in a highly relevant and current way, explain it to everyone. Not like investors who don't even really write checks or like, brands and it's been years since they actually even hit the streets and tried to get funding, but like, no, hyper relevant stuff. That's what you're getting today. We're going to be kicking off with Ryan from FABID, who his job is to know what's going on in the funding environment now, and he's about to give out all that good info. Amanda is going to tell us all about, from an investor's perspective, how you guys can be out there trying to raise right now in these difficult raising times. And then David, who can show you that it can be done and has been done recently, is going to give you a bunch of his tips as well. Guys, I've looked through the materials already for this presentation today. It's amazing. So get out your notepads, which you don't really need because we will send you actually the slides around afterwards, as well as the recording, which will be on our YouTube. So um, maybe just real quick intros with everybody before I pass to Ryan to start. Ryan, do you want to go first?
Sure. Nice to meet everyone. I'm Ryan. I'm the founder of FABID, which has a fairly relevant acronym, stands for a Food and Beverage Investor Database. Prior to starting FABID, I was a banker at Houlihan Lokey and also ran finance and ops for a venture-backed coffee business called Rise Brewing for a number of years. Just excited to be here and share a little history and insight on CPG, investing and so forth. Thanks for having me.
Thank you. All right, Amanda, do you want to go next?
Of course. Hi, everyone. I'm Amanda. I'm an investor here at Collaborative Fund. We're a New York City-based venture capital firm celebrating our 15th year of investing. We are a generalist firm, but we have a really long history of investing in great food and bev brands, including Olipop, Farmer's Dog, Sweetgreen, Blue Bottle Coffee, and more.
All right, David, my friend, thank you for joining us.
Yeah, of course. Hi, everyone. So I'm David. I'm the co-founder and CEO of Aplos, and we are a functional non-alcoholic spirit brand that is reimagining the adult beverage occasion for a new generation. So excited to be here with you guys.
All right, perfect. Thank you, guys. And I'll pepper you with some questions as we go along, but each person has their own slides. So, Ryan, can I pass to you to kick us off here?
Absolutely, I can start here. So just a quick context on us beyond my intro. Yeah, we work with a number of brands on finance, accounting, and so forth. And so I see a little under the hood of all of our companies going through fundraisers to just give some context of some opinions that come thereafter. And I thought for this call, it would be helpful to have almost like a little bit of a history lesson of how it's become comparatively difficult to raise in 2025. And so I put together this list of transactions from back when I first got interested in CPG and food and beverage in particular, which was around the time I was ending my my career at Houlihan in banking. And back then, a couple things. One, there was comparatively fewer firms, institutionally investing in CPG. The second is there were relatively smaller exits, both in terms of like the size of the companies, or the amount the companies were being acquired for, but also how much revenue they were generating. And so combined, I think this kind of intersection when, if you remember all the way back to 2015, 2016, when Facebook and the kind of VC tech, world was picking up steam, CPG was a little bit of a step behind. And I think that drove some investors correctly to realize that there was an underserved market and opportunity to back CPG, which could have huge exits. One that I think many of us remember was Buy, which sold for almost $2 billion back then. And also just the barrier to building an exitable brand was much lower. It didn't necessarily need to be profitable. And so I think I remember also always seeing VMG's name. It felt like attached to every third transaction, which I think, maybe some GPs and firms turned around and thought, well, maybe we should get in this game as well. And so that's what kind of happened. So we track actually like every firm that has invested in CPG, and then when they launched, and it makes this like uniquely kind of beautiful graph of what the kind of number of firms getting into CPG looked like, that I think tells a story with like not needing to have a whole lot of asterisks. And that relationship between CPG focused funds, but also funds that were, initially focused on tech, entering CPG, or family offices or so forth, really drove a pretty significant amount of capital into, into the types of businesses presumably everyone listening is building. And so not only were there more firms, but there were more dollars. And so if you look, there's kind of this, growth through like 2019, but then the capital actually peaks in 2021 and 2022, which follows, when those firms were launched, and then as they began deploying capital. And for reference, this data is all cut to be as relevant as possible to, I would say like the types of brands you see at Expo West, not food tech, not, there's no international. This is the US CPG, kind of like, could you imagine that brand having a booth in the North Hall of Expo? And so that number went back up, and then of course it started to go back down. And I think the question is a little bit why. So one thing that I found really fascinating is, as the quantum of capital going into CPG really was growing in 2020 and 2021, there were still a ton of headline exits. So these bars represent big M&A and big IPOs during that era. You have everything from, this big blue one was Body Armor's huge exit to Coke. This big light blue one was Oatly's IPO. So there were ways that capital was getting returned to investors for a long period. And then it basically stopped for not just 22 and 2023, but for a lot of 2024. And so I want to say it was like an 18-month span, there wasn't a single venture-backed CPG exit of, $300 million or more, or in a way where, the investors made kind of a return that justified their risk. And fortunately, really in the past 6 months or so, has it only just begun to kind of reset, and we've seen off to the right, some great exits of companies that did have institutional back in. And I think that is like this key unlock for, as all markets moving in cycles of getting kind of more capital back into the CPG ecosystem. So for now, it remains difficult though, no matter where you're at, whether it's pre-seed, which we just use the amount that's invested because the definitions of change. But if anyone is like, is it just in my head, has it gotten harder, or has it actually gotten harder? It has gotten harder. There is less funding available, and it's gotten harder for everyone. So this just shows kind of the count of brands by year, by stage. So hopefully this helps you visualize it. So okay, I think I want to move into maybe like a more didactic section of this, which is like what makes a brand backable. And I think Amanda and David will have probably more insight than me on this one, so I don't want to over speak my turn. But I would say a few things on this slide I would at least try to keep in mind. One, efficiency, meaning like efficiency of the capital that you raised. So in the growth at all costs era, like if you raised 2 million and you got to 2 million in sales, you could go raise another 2 million to get to 4 million, to raise another 2 million to get to 6. I think like now there's, like a disqualifying ratio there, where if you're not if your scale is not outpacing the amount that you are raising to get there, it is sometimes reflective of some fundamental issue with the business you're building. And I think many investors are now very kind of weary of that. So I think just targeting, for every dollar that I raise, can I try to grow my revenue by 2 or 3 or 4? I think is just like a good simple metric to try to keep in mind.
In easier said than done on that one, but I remember I watched on Shark Tank. Mark, I think this was when he was evaluating Drink Wonder, and who like killed it up there, and he's like, yeah, this is good, but it's going to, like, for you to get to 50 million in sales is going to take me 50 million of investment. So like he actually had this number pretty prescient, like pretty top of mind for him. That was interesting to see. But also, like, you see brands like Liquid Death, how much did they raise? It was like many hundreds of millions, which means, and I mean, so I don't know if everyone gets this ratio, but I mean, that would be, if you can get that ratio, I think you'll have a pretty easy time raising money.
Absolutely. And, you know, at the very beginning, I think it's extra hard to hit that because your order minimums are, you know, make it challenging and you still have some fixed, you know, overhead. But as you kind of cross, you know, into the kind of 2 to 10 revenue area, I think that's where like a lot of companies get tripped up. And I think that's where you're supposed to start to see some spread between the two. I think you know, the other ones are hopefully somewhat self-explanatory, but just you know, market need, a brand that's cool and resonates. You know, are you pursuing a large market opportunity or a small one? Because I think a lot of founders would do well to kind of like think of yourself as an investor in your own brand, and does it make sense to you if it was your own fund that, you know, can I, you know, does it make financial sense? Can the company become big enough? Those kinds of things. So these are kind of my 5 things I would pay attention to. And then you know, my last slide, and the one maybe to spend the most time on, and the one that I think a lot of people are interested in is, well, what's kind of the valuation for different businesses? And I think this becomes more of a science the more profitable and the later stage you get. When you're a $200 million business that has stable EBITDA, there's like, you know, you can have a discounted cash flow, and like you can be very analytical of how to value your business. I think for our universe, it's much more, again, kind of an art. And even of all the businesses we work with that go through fundraisers, we see everything from a $4 million brand that has been around for a few years and maybe didn't grow quite as fast as they want to, struggle to raise under any circumstances. And then another that's got, you know, $1.5 million of trailing revenue, but great velocity, super exciting, and they're raising it, you know, 7 times their trailing or 10 times their trailing revenue. So I wouldn't approach your fundraise as what's a multiple I should put on it. I think a couple things. I bifurcate your like approach to valuation of, one, what's like the foundational value of this concept I'm pursuing? Obviously at day 0, where you have 0 revenue, your company can't be worth 0. So there's kind of this like anchor value to a business, which from my seat, we see kind of, I would say 3 on the very low end to maybe 7 or 8 on the very high end of like a pre-revenue business. And then on top of that, what's the value of your revenue or traction? And the sum of those two is what I think creates, you know, where your kind of valuation will ultimately lie. Couple final things. What I would say is interesting is, like, if you notice, I intentionally have this, that when you're at 0 in revenue, your valuation is probably between 3 and 7 million. But once you start generating revenue, really until you get to probably 20 or 50 million in sales, the value of your company is really, the low point is 0. Because if you have a $100,000 business that's been around for 2 years and it's not profitable, it's very hard to raise on that. And so I think being really conscientious of getting enough capital to hit an inflection point where you can raise based on traction is kind of a key that I would look out for. And so, yeah, obviously though, as you grow, you know, your valuation hopefully moves in lockstep with you know, with your revenue. And I would just say couple final comments for my little section of this. The companies we've seen be most successful just with the fundraise process are those that, I think they cultivate their investor relationships in an unstructured kind of way when they're not raising. They like make friends, get introduced, are visible, have like those relationships. But then when it comes into the actual fundraise, then they're very tight and orderly. And I think sometimes the handoff between the two can be confusing to founders. But I would say like just really it's so much easier if you already have an established rapport, especially with someone that can lead, as opposed to like we need money now. Let's hit up everyone and see who's in. That can be kind of difficult. Um, and yeah, I happy to answer any questions, but hopefully this is a helpful kind of framework. And thanks for having me.
Fantastic leadoff hitter. That was great. And the data is so helpful, especially just to know what can be the valuations early stage for people. Very different from what you'd hear on Shark Tank too, where they're like, I have 5 million in sales. And Mr. Wonderful is like, well, then you're worth nothing to me. Like, but it'll be, yeah, we'll come back to that at the end, maybe for questions just for across, I would say each of you, but that was really great. Amanda, do you want to share your slides and
Yeah,
we'll
I'm going to
jump.
try to pull it up right now.
Perfect. I'll just keep yammer. Oh yeah, here we go.
Okay,
Okay, cool. Yeah,
perfect.
yeah.
And
If
let
you
me
want to go
try to
into,
get to the presenter view.
yeah,
Allow, and I want to, sorry, this bar is blocking where I can see how I can press present.
yeah. If
And
you, yeah,
then
do you want to hit the presenter
view.
thing down at the bottom, or oh yeah.
Do you see it?
Well, the little icon down at the bottom, right? You can hit for presenter mode,
That
or you
green,
can.
it's like
It's
Oh, I see.
amazing that I live in my, like I never use PowerPoint, and right now my banner is being
Oh, I see.
is
You can
closing.
also
Let me
you can go to
see.
slideshow and present, but then sometimes you have to
Ah,
share that separately.
okay.
Like
Slash
sometimes,
play from the start.
yeah.
Do y'all see this? Is it
Yes,
full
there
screen?
we
Okay.
go. It's
Okay, amazing.
beautiful.
Thanks, guys. Sorry, I can't believe I am a tech investor and I still have my own tech failure all the time. I didn't learn anything from the pandemic.
So Amanda,
Um,
first of all, just as we're jumping in, what did you think about those slides from Ryan? Those kind of numbers? Do you want to just call them out as a total BSer, or just see pretty much right
No,
on
my
track?
gosh. I love Ryan. First of all, Ryan has been such a saving grace during my buildup for here at Collab Fund. And as I think about CPG investing, we ping each other all the time. He's also just the best. I can't recommend him enough. And he's such a great early stage partner, especially on the bookkeeping and on the FP&A side. So no, I am Team Ryan forever and always. And
All
also
right.
Team CPG community. So a lot of that really resonated. When I put together these slides, I just wanted to put some tips of when you're putting together a pitch, maybe just some things to consider. I tried not to be overly prescriptive, but just maybe some things to think about with the context of Ryan's slides talking about the broader macroeconomic environment. So the first thing, when you are pitching someone, maybe the first question is like, who am I pitching? There are a couple different types of investor types within CPG investing in general. You can talk to VCs, and that's someone like me who's either an institutional VC or they work at a corporate VC. The second are kind of family offices. Third are CPG angels, so individuals. And the fourth are really our strategic groups. And then there are a bunch of different archetypes and investor types in between, but I think these are the kind of the four that I see the most on cap tables. The second piece that really informs is thinking about the investment structure. So think about how that investment category or the type really informs the way that they would form an investment. So for VCs, you should really think about what's the fund size. So how big is the fund are they deploying out of? Here at Collab Fund, I typically write checks out of a $125 million fund. That's completely different than if I was a dedicated CPG investor writing out of a 30 or $60 million fund. The math and the mechanics just look a little bit different. The second question I would then ask is about the fund life. I would maybe ask, hey, what year are you deploying out of? When are you looking to return capital back to your LPs? And that kind of also informs the exit math that you're looking at. The other pieces I would think about are average check size, how much would they actually write as an investment size, what their target ownership looks like, what their return profile looks like. That really speaks to kind of the fund size and life cycle. And then also just the value add. So when I talk to different CPG operators here at Collab Fund and founders, I'm able to talk about the different pieces that we help to provide other than just capital, and also on the strategy, whether that's having great relationships with retailers or having a full-time design partner, helping them think through operations, et cetera. But those can all be kind of different toggles as you're thinking about different folks that you want to bring onto your cap table and who you're pitching to.
Amanda,
And
is
then
it
yeah,
just on that investment? Those are
of
very,
course.
it sounds very smart. But if I'm like talking to an early stage fund, am I gonna piss them off if I'm asking them this? Like, hey, well, what's your fund life? Am I gonna sound smart if I do that? Or are they gonna be like, why are you why don't we just
No,
see if I'm even interested, first of all? Like,
at least like that's not my perspective. When I have someone who's asking a conversation, I almost think that pitching is kind of like dating. You want it to be the right match for both of you. And also, it's a long-term relationship, right? Where your typical VC is investing out of a 10-year fund. That's a really long relationship. I think it's important to go in eyes wide open about sort of what the constraints are, or not even constraints, but sort of different factors that different investors are looking for. I think it's great to ask questions, especially if it's coming from a place that's open-minded. I think tone can also inform a lot of that, right? Like it's one thing if you're grilling someone and you're like, I really don't like that you're based in this city, or I really don't like that you have this kind of structure. That might be a little bit of a tougher, like, okay, well, then maybe it's not a match for both parties. But I think just asking basic questions, totally fine. Fine
maybe
by me anyway.
with that right tone of like, hey, I just want to know if this would be a good fit, even for
A
how you
hundred
invest or
percent. And
something.
I
Okay,
also think that's showing like I'm doing my research. I'm like really thinking about this strategically. And also like you want to be a good partner on both sides.
that's very
And then
smart.
ultimately the structure I think goes to the piece of incentive alignment, right? You want it to be a win on both ends. And I think if I was raising for my company, I would think about what are the incentives of the different investment types that I would, or the different investor types. So if I'm pitching to a family office, am I thinking about, is this really a family office that's looking for like a long-term strategy? They're trying to build generational wealth for their family. And so they would be happy with having dividends over a long period of time. Or am I pitching to a VC that's kind of, a few years into their fund cycle? So I really want to operate in a big market and have a Siete or, road style exit where they had like $1 billion exit in 3 years kind of thing. Obviously pie in the sky thinking, but like thinking of that kind of framework. Or is this a strategic that's looking for exposure into a new market, or maybe just having kind of a softener for some type of M&A activity? So I would just kind of keep those three things in mind as you're crafting your pitch. My next tip is about just familiarizing yourself with the mechanics of a successful pitch. I think Ryan touched on a lot of these when he was kind of going through the different factors of what makes a successful CPG company. But as I am going through a pitch with a founder, I'm always thinking about these 6 factors in no particular order. The first of which, for me, at least personally, is being brand. We're operating in an industry where the barrier to entry is incredibly low, and really brand is the only moat in my perspective. So really, what are you doing to build an enduring brand, and what are the market proof points that you can kind of point to guide your investor in that direction? So are you kind of building a groundswell of community, and are you showing that people are sort of fanatical about your brand and you're able to adapt based off of the market? Is it coming from a place of cultural resonance? Or are you operating in this sort of critical gap in the market that only you can serve? On product, what are your hero products? Why have you earned a place in your customer's dining room table, or in their cabinet, or in their day-to-day routine? Why would they come back to you? Is it quality? Is it taste? Is it something about sourcing? On market size, I think this is really important, especially on VCs. You want to make sure that you're operating in a big enough market that can support any type of exit, whether it's an M&A or whether it's through IPO, to really help them visualize that this is an opportunity that's supported by data. Another big piece is, of course, margins. Your margin profile has to be able to fit into that outcome. So think about both product margin, gross margin, contribution margin. And I think that's especially important today, where kind of to the opener and to Ryan's point about how it's a difficult fundraising environment, you really can't outsell a poor margin profile. So how can you really think about those from the beginning and optimize that? The next being velocity. How, if retail is a big part of your strategy, how are you going to continue to earn that shelf space, knowing that you really only have one chance to crush it? Are there any sort of signals of demand that you're really having high velocities, or any sort of market abnormalities? Another piece is, of course, team. So why is your team uniquely equipped to win? And then also maybe being forthright about, are there any skills missing? Do you bring great marketing and operating muscle, but you really need someone on the FP&A side, and that's why you're looking to bring strategic capital to kind of help build out that base? I think sometimes that can also be helpful, knowing sort of where the gaps are in the business as well. And then ultimately, knowing that we're in a market where distribution is king, what does that balance look like between retail, D2C, and how are you going to support the mechanics of all across the board? And then finally, to valuation, same thing as Ryan. I really think at the early stages, it is a mix of art and science. On the scientific part, you're always anchoring to key metrics, right? So especially for pre-revenue businesses, you don't really have revenue to anchor to, but in general, you're, looking at different components of revenue. I think you'll think of an amalgam of these three, looking at trailing revenues, your quarterly run rate, but also wanting to have credit for forward-looking revenue. Typically, investors will do kind of a triangulation across the board. The next is, of course, on your margin profile, then thinking a lot about your working capital management, especially on the cash flow management side, thinking about retail performance, how are your velocities doing? How are you thinking about retail door expansion? And then, of course, on the promotional side, really thinking about marketing expenses and trade spend. And then ultimately, to Ryan's point about multiples, it really depends on the stage, of course, that you are raising. But that's really when revenue and EBITDA multiples come into play. EBITDA, I think, is especially pertinent for PE investments much later down the road. And then the art is, I think, just remembering again about incentive alignments. So thinking about what a win looks like for you as a founder, but also for your investor. And sometimes I think it's helpful to kind of even chart backwards. We're thinking about, what is my exit? What is my end goal? And then backing in based off of the time horizon of what that looks like. And oftentimes I think the valuation can also be a conversation about just being honest about what expectations are, and how much of the company you're looking to sell in terms of the dilution, and also thinking about ultimately the incentive of your investor, and if that's something that fits within your overarching goal when you're building a company.
Amanda, thank you. That was amazing. So informative and succinct. So one question that came in through the chat from Enliven Foods is, how do you establish rapport when you're not raising? And I've heard a bunch of things of different, like, you guys are all on LinkedIn. You can reach out, like, like, do it in a nice way, or like meet at events, or all that stuff. And maybe one of the most effective that I've seen is, like, find people who love your product. If they're other
Mhm.
founders, if they're investors, if they're angels, whatever, and ask them what investors do you know? Because I feel, for me, like, almost 100% conversion is what I've seen, is like somebody they trust who loves your product is like, do you want to talk to this person? Their stuff is awesome. They're like, yeah, I want to talk to them. What do you think?
Totally.
Other ways?
Yeah, I mean, I think some of our best introductions really come from other founders within our network, either within our portfolio or also just some of my friends who are also raising. Part of that is just knowing that we get a ton of inbound and a lot of cold emails. And unfortunately, I also get a lot of spam. And so I have very aggressive spam filters. And so I try to answer every email that comes in cold, but sometimes that's just not possible. But I'll always make sure to answer when it comes from someone that we both know. And something that can also be helpful is coming in with a specific ask. I think it can be a little bit challenging when they're like, hey, I'm starting a business, I just want to chat. And if you have a really busy week, it can just be difficult to make that work and be like, I don't really know what this conversation is. So if there's a specific ask of, hi, I know that you've invested in this portfolio or in these kind of segments, I think that my business is complementary because of X, and also have a warm recommendation from Y, it can make that conversation a lot easier. And oftentimes, I think trade shows are a great time to establish relationships, especially when you have amazing samples and can build that entrenched advocacy. And that's something where I'm like, I really am bought in. I really, trust, believe this person and believe in this brand and vision. And so I want to keep a warm relationship with them before they go out to raise a formal round.
I love it. The stuff that I see that like sometimes people post on the Slack, like, hey, anyone know investors who they can introduce me to? I'm like, probably they're not going to do that. Like they don't know you, they don't know the product. But if they do, honestly, if you meet someone and they do love your, and you can tell when someone authentically supports you and just like, like, I want to help you. People do like to help. And even like people who know Amanda are actually very excited to introduce her to something that they really believe in. They'll like think they look cool if they can bring her something that increases their credibility. So like if you find those people, I think that they will be pretty happy to help you, but you probably have to ask them also to do it, to proactively make those introductions. Okay, cool. Amanda, I'm going to come back to you with some questions in a little bit, but I want to make sure that we get through all of the slides that David so kindly prepared. David, if you want to start your screen share, and while you're doing that, I am going to crack open a lovely Aplos. I've got here the cola fashioned because I like old fashioned. So this is a delicious non-alc RTD that I recently ordered at Soho House. I think you must have a national deal with them, which is beautiful.
Yeah, we do. We do.
It's so good.
Well, thank you guys. Let me see if I can figure this out. Like Amanda, I'm not sure.
Yes.
Work.
Got it.
Cool. Awesome. Yeah, so I'm going to give you guys a perspective from a founder. I actually know Brian very well over the past few years. Amanda, we haven't met yet, but we should set up some time just to say hello.
I would love that.
So let me see. Here we go. Yeah, so just to reinforce, so our vision with Aplos is to really elevate non-alc beyond the moniker of mocktail and to build a brand that anchors the bar of the future. We are function-led. We are made by the best mixologists in the world. And so that is the vision that we have. And so
that is true, by the way. I know her, Lynette. She is the real deal.
Yeah. And so first I want to take you guys through some history, right? So my background is I've been in startups since 2010, my entire career, over 20 years now, building consumer brands. Actually, before Aplos, I was not in CPG. I worked as head of brand for a menswear company, very early stage through close to exit, called Bonobos, you may have heard of. And then I was the CMO of a travel startup that we also exited in 2018. And I sort of got the itch and wanted to start something myself and had that sort of pre-founder, kind of arrogance or I think ignorance maybe of I can do this better or I know how to do this, right? And the reality is you don't really understand until you sit in the seat and you are responsible for everything. And so we started working on Aplos in 2019. My co-founder comes from Bonobos as well. We both met there. And so we've launched 3 rounds at this point. So we launched a pre-seed round before we launched. And this was honestly just on a deck in the product that we developed and the brand that we developed. And so, with each of these rounds, and I'm going to be repetitive with some of the stuff that Ryan and Amanda said, you want to be really clear, like, what are you using the funds for? And you want to make sure you're using the growth capital for growth, right? And so what are you using the funds for? And what are your milestones? What do you want to do with that capital? I often think about fundraising as like a relay race where you like pass a baton. Think of the baton as like new money, where building a company is like a marathon. It's rarely a sprint, right? And so you're raising money to get you to that next level. And so you want to prove something that you want to be able to say, okay, great, I used this money and I got this result, and I have this result that I know if I raise this much more money that I can get to this level, right? And so that's kind of like a simplified way to look at it. But we did launch pre-seed. Then we launched December 2020. We were going to launch in the spring, but COVID hit, so it got delayed. And then that first year for us was really just about proving product market fit, understanding the core unit economics of the business, like what is the repeat rate, what is the lifetime value, what does it cost us to acquire a customer, get some qualitative feedback from consumers about the product. And so it took off right away. We doubled what we thought we were going to do in our first year. And so we went out and said, okay, we want to raise a seed round because we we have some data around D2C. We want to scale that. It was me and my co-founder, the two of us for a while. And so we were like, we need to hire some people to scale the operation. And we wanted to expand the product assortment as well. And so we raised a seed round. And then that led us to a Series A, whereas we started the business in D2C. That was where we were very familiar. But really, to get the scale in CPG, you need to be really great at wholesale and have a strong velocity in the wholesale. So we raised a Series A. And so the intention of the A was to expand into wholesale, further product expansion. And we wanted to launch our RTD cocktails, which we did launch last year, expand distribution and get D2C to profitability and really focus our growth capital on where the majority of the growth is, which is wholesale. So one thing I really want to stress, because we're kind of talking in this conversation as is just a given that you're going to raise money. You really, really, really have to understand why you want to raise money. Like some businesses are just not venture businesses. And you need to do this in the context too of your vision and your category and the expectations around that, the lifestyle that you want, right? And so, there is a trade-off with raising capital versus bootstrapping. There's also a trade-off of like raising capital with friends and family versus raising institutional capital. So my biggest tip is like meet as many people as you can. Ask people if they're willing to meet with you. There are plenty of platforms now where you can actually just pay to chat with people who are really successful. And like relatively, it's kind of a small amount of money just for the advice that they can shortcut for you. So you really, really, really need to understand why you're raising and if this is the right route for you, because this is a step I see so many people just skipping, and they are just like, of course I'm going to raise money. Like, yeah, and when I ask them why, and do they really need to raise money? And again, the context of like, what is your vision? What is your category? It's all really important. So you really have to start with why you're doing it. Also, a great book, if you've not read it, called Start with Why. So these are just like really high level tips, and there's actually a lot here. This isn't everything. There's a lot involved, and it can seem really overwhelming. But really, my biggest tip for people is like, I can actually, to kind of pause here. In hindsight, the entrepreneurial journey feels very clean and linear in media and even in places like Shark Tank. That is never the case. It's a pretty messy experience. I can remember the first conversation I had about Aplos with a former colleague from Bonobos at a wine bar in Madison Square Park in New York City in 2018. I'm pretty sure I did a terrible job of pitching it, a terrible job. But there was something in me that she recognized, and she introduced me to two people. And I met with those people. One of them was a VC. I went with no deck. I didn't even really have a pitch on. I met her for coffee. I like go there. I'm in Brooklyn. I'm like pitching this idea again. In hindsight, I'm pretty sure I did a terrible idea. But she knew I was very early in the idea, and she encouraged me and introduced me to two or three other people. It's that first person that really saw something and encouraged me and introduced me to other people. I always say to people, you just got to follow your curiosity and you just have to take the first step. So I'm going to go through a lot of things here, and it's going to seem overwhelming, but you really just have to take that first step. And so again, start with your why. I would say you have to be really convicted in your vision, but malleable in your strategy based on what you learn. You can't be so rigid that like, I'm going to build this business on Amazon and it's going to be this big. And for this reason, I'm going to do these SKUs. Like you have to really listen and look at the data, both the qualitative and the quantitative data when you put something out there. You need to ask yourself, like, what is your desired outcome? What is the lifestyle you want? Like, what do you want to get out of this, right? It's really important. Understanding the trade-offs of bootstrapping versus raising capital, And most importantly, seek out and talk to other founders. Like I try and dedicate an hour a week where I'm just talking to people who are building businesses because I like having those conversations. And I also feel, it's kind of my way of giving back of like, let me tell you what I did wrong, right? And like help you out. I actually think I saw a guy in the call, Ben, who I've had a couple of calls with. He's building a company now. And so the second piece is educate yourself. So fundraising can be really confusing. Understand the vehicle that you want to raise under. Is it a SAFE, which it stands for simple agreement for future equity? Is it a convertible note? Is it a price round? If you're very early stage, it's probably not going to be a price round unless you're maybe a tech company. Really understand, become a student of the market. I don't come from beverage, which working for other founders I think is a benefit because I have beginner's mind. I'm not encumbered by the ways of thinking in the bev alc industry. And so I can think in new ways, but I also know that I need to understand the rules of the game. And so I proactively sought out people that were experts in beverage alcohol, but also in the what at the time was very nascent non-alc category is now becoming more and more important. And then also understand your category benchmarks. So like it's very different in like sweet and salty versus like non-alc for me versus like, I'm in the beverage alc kind of part of non-alc, but then there's like poppy, right? Which is like the benchmarks for like a company like Poppy, they needed to be doing hundreds of millions in scan sales in order to have a successful exit. But it's different for me, right? And so valuation multiples, exit requirements, if you want to sell, who are the potential acquirers and what do they value and what do they look for? And find a mentor from your category as well. I'll try and speed this up a bit. So Amanda had a great list, and you guys are going to get this deck, and I would highly recommend kind of looking at her list. But early on, you really want to tackle like what's the problem that you're trying to solve? What's your solution? How big is the market opportunity? What's the competitive set? How are you different? What's your go-to-market strategy, the unit economics or your margin? Your projections, use of funds, target milestones, team. And I will say, you know, everyone's going to have an opinion on your deck if you're showing it to friends. This is why being convicted in your vision is so important. There are core things about your story that you need to have there. And I would, again, look at Amanda's list. But everyone's going to have feedback on your deck. And if you listen to every single person's feedback, you're going to go mad and you're going to make hundreds of versions of a deck just to make one person happy here and there. And you're going to drive yourself crazy. So progress over perfection. If you're happy with it and you have the core stuff in there, great. Hone your pitch. I've pitched over 500 people since I started Applos. I have a master CRM where I track people, but also like in parties and like I'm constantly talking to people about Applos. The more you talk about it, the more you'll start to see what resonates with people. And also, you want to give the right pitch in the context of the person you're pitching. That's why I always like to ask people questions first, because some people are really brand focused and emotional and they're investing more in that. Some people just want to know the numbers, right? Hone your pitch and pitch with as many people as possible. Focus on the product. So I see a lot of founders just build a deck, try and raise money, but they've not actually made the product yet. That sounds crazy, but it happens so much. I think the first capital, your own, or if you raise friends and family that you raise, you need a great product. Nothing else matters if your product is mediocre, right? And so focus on that. This is kind of the basics. So get a lawyer. If you're going to raise institutional capital, most people recommend a Delaware C Corp. This is not legal advice. Disclaimer, talk to a lawyer. But also get your trademarks in order, your investment docs. So I mentioned like a SAFE or convertible note, things like that. Be ready with the data room. This may sound overwhelming. If you're pre-revenue, you don't really need a robust data room, but you need a deck. You need like basic financial projections, like reach out to Ryan if he has time for you, or maybe he can refer someone. Sorry, Ryan, if I'm giving away your time, not really, but you know, things like incorporation docs, trademarks, those kind of things are really important. There are a lot of stories of people building businesses and then trying to raise money and then realizing they don't have the trademark and then they have to rename the company. Uh, Build a prospect list. So send up a CRM. I recommend HubSpot. It's free. You can integrate it with your Gmail. You want to identify qualified investors for your stage, your category, your check size. So it's really important that you're not like reaching out to people that are, you know, looking for you to have $5-10 million in revenue, or their minimum check size is like $5-10 million if you're super young, right? You know, and I think people ask me, where do you find investors? Honestly, I source from friends, former colleagues, LinkedIn, from Brian and FABID, PitchBook, Press, like, you know, all of these places are places you could find investors. And then you want to sort of build and run a tight process, right? So outreach, intro meeting, and initial pitch. Intro meeting, I really like to take the pressure off of those and make it more about let's just get to know each other. And I like to hear from the investor first about them and what they care about before, because you can kind of tailor your pitch to who you're talking to based on, you can sort of ask a series of questions to understand what they care about. Um, then obviously you want to like get them to try the product, and then there's diligence and legal and closing. And so this is a simplified kind of high level list. And again, it can be overwhelming. That's why it's important to like find a mentor or an advisor and like have them kind of help you through this process if you've never done it before and you just have to start. Because honestly, I had no experience doing this 5-6 years ago. I just learned by doing. I have a few more tips here you guys can read when we send this out, which are like, again, get the basics up front, like what's their investment thesis, stage, check size, traction requirements, etc. I'm farther along than some people. I don't want to assume I'm farther along than all of you guys, but like I always ask them about their process, like what gets them to a yes, what gets them excited. Um, Early investors are really investing in you, right? Like if you don't have a lot of time in market or you're pre-revenue, like they're investing in you, the team, the belief in the product and the market opportunity. And so those relationships are important. To build in an organic way as much as possible. You got to know your numbers, even if they're projections, like because you know early on, like I've made so many mistakes in investment meetings and in pitches, right, where people ask you like, you know, a specific KPI like your lifetime value or you know your gross margin and things like that. I know obviously like the back of my hand now, but you would be surprised that some people don't know those things like the back of their hand. This is like a very high level simple tip, but like make introductions easy. So the best, my experience with funds like Amanda's is like, again, she gets tons of emails all day long, every day. But if you craft a warm email and you know someone that knows Amanda, then you can send it to them and they can forward it to her and say, hey, I think this company's interesting. Let me know if you want an introduction. And those are so much more successful in my experience than just cold outreach, right? You want a qualified lead. And so having someone that she knows introducing you to them, I would assume she's more likely to respond. Um, I think learn how to, I have a misspelling here, I apologize, how to manage your mindset and build resilience. You will get lots of no's. This is not about you. The no is not necessary. You have to reframe it. It's not a rejection of you. You never know. Investors, they don't want to close the door on an opportunity that could be a big opportunity in the future. So you may get a lot of responses that don't give you the exact full picture. Um, and that's okay, right? Like if you're too early or you're too far along, or I need to see more traction here, or it's not a fit for this reason, like very rarely will investors, at least sophisticated investors, be like, no, I'm never going to invest. They'll be like, it's not right now. And so, you know, you got to build resilience because you're going to get a lot of no's. Um, you know, I think understanding potential alignment before sharing too much, like at my stage, there's our category is really competitive, right? And so I don't send a deck to an investor before I have a call. I'll give them like high level updates and see if they're interested in chatting. But I want to make sure that there's interest before I'm giving away too much in my business. And that kind of is important, I think, through a context filter of how far along are you, what's your category like, that sort of thing. So not a tip for everyone. Um, I mentioned this, everyone will have an opinion on your deck. Seek out advisors who can build your credibility and help you avoid mistakes. And I know we're all used to working remote and we're on a Zoom call now, but it really helps to meet in person when you can. So I highly recommend that as well. These are just like a few things I would recommend. There's so many others, but hopefully this is helpful.
That's so good, David. Thank you. And I just one thing I was reflecting on is like David has obviously been really successful. The way he did it is not the best way for everybody. It seems like it's been really good for him, but you've heard him say some things that most people don't have some of the skills that he has. It's quite uncommon for like the former head of branding for Bonobos, so that which is like the OG direct to consumer brand, then comes out and is going to launch a new product. Like, yeah, that he's going to kill it on ecom, right? And so other people may not have that same ability to just come out and destroy it. And I know if you can listen to David's episode on our podcast where he talks a lot about like using fashion influencers for his brand, because that's like those are relationships that he has and skills that he can like how he can grow his brand. But you're going to have a different skill set that you can leverage. So your path may be a little bit different in the kind of things that you can do to grow in the early stages. David, because like you're such a strong person on branding, and like I saw people commenting in here, this is just it's such a beautiful product, and the spirit as well that you launched with. How people ask like how much should I invest in branding at the early stage? And we get a lot of products for the shelfies. Some of them honestly look terrible because people have underinvested in packaging and they have kind of crappy labels on cans or put on, stand-up packaging. I'm like, I don't know. I think you're kind of shooting yourself in the foot. Like if you send this to an investor, I'm not sure they can see the potential of it. Like where do you stand on that? I'm like, you don't have money, and when you haven't raised money, on how much you should really put into packaging and design and all of that in the
Yeah,
early days, and probably you're going to change the product later too.
yeah, yeah. Yeah, well, I want to comment on what you said before, that I was killing it. I think it doesn't always feel like that way for me, to be honest. Like I've gotten a ton of rejection, and again, it takes a lot of resilience, and things can look really glossy on the outside. You never know what it is like on the inside. And so I always hate these stories where it's like this founder raised $50 million off this pitch deck. Take a look. It's like, yeah, okay, well, there's so many things behind that. That is like, as a broad statement, bullshit. Like they probably were nurturing those investor relationships for a long time. And then, as Ryan said, came to them and said, hey, I have this big opportunity and now I'm raising. And yeah, maybe it happened in 2 weeks, but they put a ton of work in before. So this stuff is really hard, even for me, even to this day. Like being a founder, some days you feel like you're getting punched in the face 5 times, but some days you feel like you're on the top of the world. So like it's like it's hard for everyone. But back to your question about branding. So that's my background. I'm a brand guy, right? And so I always say lean into what you're really good at and find people that are really good at what you're not good at. So I had never made a spirit before. I talked to over 100 bartenders before we launched, and I wanted to bring one in as a master mixologist. And my friend just happens to be a restaurant lawyer and reps a lot of like personalities in food and beverage, like chefs and things. So she was like, you should talk to these people. And I met Lynette. She did the master class for mixology on masterclass.com and is really a celebrity in the bartending world in her own right. And so she really resonated with what we were doing. And I said, I want to build something that is not mimicking a traditional flavor profile. I want it to be able to stand up as a lead spirit in an infinite number of cocktails. I want it to be functional, and I want it to have that versatility, sophistication, complexity of a traditional spirit. That's really hard to do. And so I brought her in to help. And then I have a technical formulator as well. And so on the branding side, like that's my background, and I'm very as my business coach says, aesthetically minded, and I care a lot about that. And I'm trying to elevate non-alc beyond the moniker of mocktail, right? And so I wanted to build a world because I like brands that make you dream, that aren't so like literal talking to you. And so that is really my background. So I think if it's not yours, I don't recommend going to, I mean, context is important. So it's like, can you bootstrap this? How much money do you have? How big is the market? How big do you want to go? Right? All of those things matter because maybe you can't afford a big agency to do the branding. Um, but most people can't. And so I would say seek out brands that you like that are maybe smaller, low conceived, find creative directors. Like early on, I would offer people like advisor shares to help me. Like our first financial model, I didn't have any money, so I like gave someone a couple thousand shares to like do a financial model for me, right? And so if branding was in my background, I would find what brands do I really love? Can I find design directors or creative directors who've worked for them? Or if it's a brand like Glossier, who's worked on their design team in the past, can you find someone who's maybe underneath the creative director or the art director that's doing freelance that you could talk to, right? And so you can be resourceful, you can offer advisor shares. For our branding, like I did offer shares as a part because I hired a creative director. But then the strategy of the brand and a lot of that stuff, I in relative terms didn't pay a lot of money for initially because it was my experience. So I think lean into what you're really good at and seek out people that are really good at things that you're not as good at. And in CPG, packaging is so important and branding is so important. And getting someone who understands how to stand out on shelf and really understanding what they're what people are going to respond to is really important. So, that's important context as well, because you can have something that looks really beautiful, but like if it doesn't communicate to the consumer on shelf in a way that makes them want to pick it up and look at it, then it could be a waste of money.
I love it. And David, I think you need to do a masterclass also now on this. So I hope we can get you back on the podcast just to go through this because we're going to run out of time in a second, but there's so many more things I wanted to ask. And sorry if we didn't get to everyone's questions as well, because there's a couple hundred people on here, but thank you for all the nice comments in the chat about how valuable this info is. I agree. This is an incredible speaker lineup who really put a lot of thought into all of this. So definitely everybody go to aplos.world and grab you some delicious aplos. You'll be very excited about it. And then just to finish up with Ryan and Amanda, then can you guys just maybe, is there a good way for people to follow along your work or follow up with you?
I would say DMs are open on LinkedIn. As any good VC, very active there. Amanda Amos, I'm an investor at Collab Fund. And then we also have the Collab Fund website and our LinkedIn as well, where we post a lot of blogs and insights.
All right. And I think maybe Amanda also will join a panel with us at Fancy Foods
I would love
as we
that.
just brainstormed about. So hopefully let's make that happen. Everyone come and join up. Okay, Ryan, same question to you. Best way for people to follow up with you, stay in touch with you. Thank you. Oh, you're on mute, Ryan.
My email, I'm Ryan at thefabid.com. One day we'll have a beautiful website like Amanda's and David's. For now, it's pretty bare bones, but yeah, just Ryan at thefabid.com. I'm also on LinkedIn. Feel free to connect with me there, and my DMs are open as well.
All right. Thank you all so much. This was honestly fantastic. We'll get this up on the YouTube, so make sure you're subscribed there and you'll get the slides emailed out to you. And yeah, I think a lot of follow-up content that I definitely want to do here. And just because I have all of you right now, if you aren't tracking our grocery run events, make sure you are. We're getting a lot of investors as well as buyers at those. So just stay tuned on our Slack for notifications. We have some very heavy hitter ones that we're about to announce. So really excited to see all of you at all those. All right. Thanks, everybody.